What's going on, Tim? How we doing? Unfortunately, I don't see the mountains, but we got Tim. That's all that matters here. Let's get.
I'm back under the fluorescent lights, which
yes.
Which is unfortunate. But
tell the truth, Tim. You're in your bunker.
I'm hanging out with the art collection. Yeah.
I can see Tim having a bunker. Don't worry. You invite me, Tim, because I'll keep it laughing out there. I'll keep it funny. Let's go. Let's get right to the action. Of course, this week is the big bank week, right? I mean, what are we going to be seeing here, and what's the data telling us going into this week?
Well, that's a lot in as a setup, Mitch.
You know it. You know it.
Good to see you. Happy Monday to you guys. Well, let's have a look. So there are two words as I'm listening to you talk about big tech and Tesla. You know the words going through my head are supply and demand. No matter what the charts indicate, what ultimately determines what direction everything goes. The economy, the business you operate, the stocks you trade, ultimately it comes back to supply and demand in the market. And so let's take a look at big financials. Since those kick off, I want to say Friday. I think it's Friday. I think it's Friday with Wells Fargo, couple others. And so let me see here if I.
It's actually Wells Fargo, J.P. Morgan, Citigroup, and PNC. I mean, that is the day. That is the day.
This is kind of odd. Oh, there we go. Now we got it. Okay. Sorry, the screen was giving me different stuff than it normally does. And is this working, or are you not? Are you only seeing me?
I see our StreamYard right now. If you could swap it with the market structure.
So you're not seeing Tesla, right? Yep, I see the issue. Okay, hang on.
No worries.
Careful sharing those screens, Tim.
Hold on. Yep, I can see the issue. Okay, bear with me.
We can get that location in that bunker right quick.
I have not seen what it showed me. It was unusual. Okay, so
no worries. When you hit the present, sometimes we'll see windows at the top, and then you'll see entire screen on the top right.
Now, for the first time ever, it shows me a blank. Just blank. Done. Yeah. So the only thing I can do is share a window for some reason. I don't know why, but we'll take this window. Okay.
That's just Chrome giving you some issues, but we'll do the window. There you go. I got you.
Okay.
We're up.
I noticed that I've got Tesla up. Yeah. So let's go to big financials. By the way, this is Tesla year to date. Since we're here, we might as well talk about it briefly. Yeah. So, Mitch, if you're going to short Tesla, you want to short Tesla when demand begins to deteriorate and you come down and look at supply is very high. If supply is 65% short and demand begins to deteriorate, that is the time to short and keep shorting all the way till everybody covers. That's really the way to do it. So where are we now? We're right at 5, but supply is falling. I would not short
that
Tesla.
Supply.
I would that no matter what. Now it could be that demand will deteriorate. If demand does, you're fine. If demand deteriorates and supply right, and you've got something working for you, which is the broad market sentiment. We'll come back to that. But let's go over to big financials. This is what you want to look at. But if you're going to trade things, folks, into earnings, this can be very helpful to you. You want to know what the supply-demand balance is before you do something, because it's the best way to avoid getting caught out. And so if I look at, I've got big financials isolated to these 6 big banks. And, there are other things you could put in here, presuming you can see my screen. And okay, good. So, if I look at these, you could see the things people are favoring. And it doesn't mean it won't change into earnings. But right now, people are favoring, I'm a little bit surprised by that, Wells Fargo, because it's at 5. It's right in the middle. But supply is 30%. In the broad market, it's 50. Realize the broad market is 50% short, actually 50.5% short, And so 49.5% long. If it's more short than long, what will be the bias of the market? It will be down. Doesn't mean it's going to fall apart. The market in the last week, basically flat, Dow up a little bit, S&P 500, NASDAQ down a little bit, right as we expected. Remember, we talked about this last Market Structure Monday. I said things will change in the new quarter. All that boom will end. Doesn't mean that tech's going to fall apart. Communication services has done fine because it's a perfect, but it's a large cap, passive large cap blend is communication services. It's the largest investment category in the world. So, but look at these two. Those two look good. Goldman Sachs, 50% short. Morgan Stanley, 51% short.
Tim, can I just stop you for a second, because we've had a lot of new listeners coming in, and when you're saying 50% short, people might be like, well, I look at this short interest on something like Goldman, it's probably, I'm guessing it's probably like 3 or 4%. Your stats are not short interest. Your short is coming from where? Can you explain it?
So the short interest is a 1974 measure, folks. Mm-hmm. Are you still driving a 1974 car that you haven't restored? So that's how it's
2015.
Right? I drive a 2016 Lincoln MKX. So cars are depreciating assets. Beware of that. That's So this measure came from the reinstitution of an uptick rule. The SEC put in a modified uptick rule, meaning there are rules around shorting, and that happened in 2010 and 2009, but the data set began to be furnished to the public in 2010, and it's called short volume. And it merely means, very simple, folks, all trades are either long, short, or exempt, and very few of them are exempt from these rules. There are a bunch of exemptions, but call it 100% of volume is either long or short. So what this is telling us is that 50% of the trading volume in Goldman Sachs is short. Now, it's about the same as the market, believe it or not. But if I'm looking at these, this will immediately tell me, because the beautiful thing about market structure is it's objective. It is not biased by politics, economics, pick your thing. It reflects all inputs. And so all the inputs say these people are more long Wells Fargo and JP Morgan than they are Goldman Sachs and Morgan Stanley. Now, but that's what that data set means. It is short volume, not short interest. Short interest, we track it too, but it is not the way, if you're trading short term, to use the data. It's not going to help you understand.
It's a market making measure here too, is it not? When you're talking about short volume, because majority of your orders out there are market makers, and people think that they're trading, I'm trading with the pharmacist, or I'm trading with this. For the most part, you're pricing an order, you're usually trading, with a market maker on the other side of it.
Absolutely. That's going to be well over 50% of the volume. Well, and if you're a retail trader, that's you and me.
Yeah.
95% of the time, we're going to be trading with a wholesaler. An
off-exchange market maker.
Exactly. I finally had 3 or 4 trades make it to the exchange last week. After
they make it there when times are crazy.
And it's a sign of weakness, right? If I get a trade that executes at the NYSE, I'm concerned. If I have a trade executed in an NYSE retail liquidity program, which means somebody got paid to trade with me, I know the price is going to go down, and I'll sell the rest of it. So, right, I'm the sucker. But yes, and that you should know this. This is the hard, guys. This is the hard part about trading meme stocks. If you think you're going to short squeeze somebody, you need to understand the market better. Market makers can create stock to fill trades. Exactly what happened here. There was a huge demand. This is the bank crisis right here, and this is Citi. And Citi had a whole bunch of people short the stock, but it was covered within 2 weeks. Right? So this is a trade. It does not tell us about the health of Citi. It only tells us that people hammered Citi short, but immediately covered. And probably most of that is market making. Happened back here too. This is where Citi stopped rising. People began to think there were trouble in banks at the end of January. And you can look at other banks, you could look them up. Go look up Truist Financial. This is one. It's been a great. Look, I've got no knocks against Truist, but you can go look at it and know what everybody thinks about Truist. It's very handy to be able to look and see that everybody was short this stock heading into the banking crisis. Look at that huge spike. But now where is it? Back to 40. So you can't continue to short financials until this returns. When it does, you can. I don't know when that's going to happen. It will. I'm telling you, it will happen. All we saw was not even one shoe drop. So there will be more things that are coming, but the data will tell you. And don't try to short something because you think it's going to go down. That's a terrible strategy.
Just to expand on your system, like it's more of like follow the market maker system, correct? To a certain extent, because if the market makers are scared to short the stock, maybe you should be scared to short the stock too. Is that kind of the thinking behind it?
In a way, because who is going to know the supply and demand best in the
better
market?
than the market maker? Nobody.
No one. They're closest to the data. They consume all the data. They're going to know.
Yeah.
So, and it doesn't matter whether the global macro funds, the trend followers, the statistical arbitragers, whatever you want to pick. It doesn't matter what they're doing. If the market makers are consuming the data and going, well, we don't want to be short that, they know it all. They're consuming it all. So it's very important to know that. And you can look at the broad market. So it will tell you the same thing. If everybody is short the market, here's where everybody was right ahead of the banking crisis. And the data behaved oddly. And we were wondering, what the heck's going on? And it was the banking crisis. But they immediately covered. Then we were short. Where are we now? Well, still above 50%. But notice, this is kind of when you have rising demand and falling supply, that produces gains. And it absolutely has. But I think we're getting to, well, I don't think, I know. Statistically, see this red line here?
Yeah.
So when stocks go above this red line since January 3rd, 2022, we do the math on this. When we go above that line, stocks, only 5% of all gains occur there. 95% of the gains occur in between the two lines, the green and the red line. When we go over where it is now, 6.7, if you add up the amount of time that the market spends at that level, since January 3, 2022, it's down 15%. So what would you do? Well, Mitch, here you go. Rather than shorting Tesla, maybe you short the market. I mean, if that's where we are, there's a high probability, not tomorrow. You got to look a few days out. I would say, options expire next week, right in the heart of earnings season. And it won't surprise me if we get to those and these two things reverse, that demand is falling and supply is rising. I'm not predicting that. I'm just saying that historically, that is what happened. Because look what happened here. February 9th, 6.5. The stock market still went up, fooled people, but we knew there's the absolute bottom for shorting, absolute peak for demand. What will follow? The market's going to go down. And this is the market, by the way. And it plunged. Okay, so you can know what's coming just by reading the data here, which is the input of everything everybody knows, believes, hopes, thinks.
It's kind of like we're up here, but really there's no good reason for us to be up here.
The only reason we're up here, Joel, is this. There's been a decline from 52 to 50 in supply. That's really less than a 5% decline. That's it. That is, and you could go add it up. How much is the market up since here? About 2%. Right? So that it tells you that if it doesn't change, if that were to continue to fall, we're fine. But what is the probability of that? Well, it's statistically less than 1%. So if I were betting, I would bet that the market declines, not immediately. We could have a good up day, good down day, another good up day. It's not linear. But the linear isn't what you want to follow. The linear is price, and it will fool you and catch you out. Whereas supply and demand will tell you what's occurring. There's no perfect thing. As I like to say, it's like Winston Churchill said about democracy. It's the worst form of government in the world, except for all the others.
I just wanted to sum it up here too, because people are asking, well, how do you know Citadel or when Citadel's on the other side? You can't know a specific market maker. I mean, there's anonymous, you don't know who exactly it is, but you're kind of aggregating all the data to try to give you a picture of what market makers or informed money is doing as a whole. There's no way to know that's Citadel on my other side of my trade.
No, but it doesn't matter. You can know categorically.
Exactly.
So fast trading is Citadel. So Citadel is currently the lead behavior in airlines and cruise ships, which are peaked. So beware. Don't get caught. Don't chase that. You want to when airlines and cruise ships rise above 5 and supply is falling, Citadel's telling you can go ahead and buy. When it peaks and you start to see a change in the supply side, they know everything. They know whether there are more limit orders coming in or
the
not.
GOAT, man. Kenny is the GOAT.
Yeah,
I don't care who you
the
follow.
That's right.
I don't
Kenny
care
G.
who you talk to. The person who makes the most money in the stock market is Ken Griffin.
Exactly.
He is the GOAT. He is the GOAT. GOAT. He's figured it all. Obviously, he's got, the market structure figured, the plumbing figured, everything figured. There's nobody better at trading than Kenny.
Ultimate market structure trader. That's right.
Well, I say keep up with the GOAT then, right? I just threw up their market structure edge. You guys can check it out. Tim's right on the tail of that GOAT, baby.
And if you want to, what you should trade is diverging supply and demand. Notice that. Benzinga April 10, you want to buy stuff that has diverging supply and demand. I'll end with this. This is the stuff I would look at. And the interesting thing is there's a lot of healthcare in there, like Boston Scientific, Tenet Healthcare, Alnylam. Believe it or not, Caesars, it's down some. Sometimes you can make money. Notice that the intraday volatility for Caesars is 4%. So if it drops 4% and you have a good supply-demand divergence like that, the probability that you make money the next 2 days is over 90%. So that's the way to think about it. Don't worry about what Caesars is doing. You could say, oh, it's in the casino business and consumer discretionary spending is declining. That's a stupid thing to own. Look, it is a stupid thing to own, but not to trade. If it gives you a signal, trade it. You just have to take what the market gives. And right now, it gives short-term behavior and supply and demand, and that's the way it is. I don't like it, but that's the way it is.
All right. Like always, keep up with market structure edge. Just threw up the link so you guys can get your 2-month free trial. Check it out, team. You don't even need a credit card.
Nope.
Have a good one, Tim.
Give it a try. You guys too. Have a great week. Thank you.
Thanks, Tim.